Good morning, traders and investors. My name is Roger Scott, and today is Monday. It's February 6th, and it's 8:02 in the morning. The market's going to gear up to open up in about an hour and 28 minutes. I'm here for an early start. It's Monday. We've got a big week ahead of us. Earnings. So just to give you a little bit of an idea, FANG stocks are really strong in this earnings season. I do believe most of the upside is out of the way with the FANG stocks finishing and reporting, and I think the market's going to subdue a little bit, and I'm going to show you why. First of all, we're opening down about 145 points on the Dow. The Nasdaq's down 90 points, but here is the biggest reason of all. I want to show you two big reasons. If you look at the number of stocks making 20-day breakouts, it was 81 stocks on Friday, but look at the number on Thursday, 541. For the last maybe 15, 20 times the market began pulling back, it was after we saw over 500 stocks making a 20-day breakout. Now, is this significant? Is this meaningful? Yes, it's very meaningful because that is a lot of stocks showing upwards momentum. So when you see this kind of a blowout and then you see afterwards 80 stocks and a big down day, it usually says the market's overdone. That's the first thing. The second thing is, I want to show you this, and this is really important before I get into the nitty-gritty of this week. If you look at the 11 sectors, at the major sectors, and this doesn't happen very often, notice how fragmented they are. Communications is all the way on top, technology is in the middle, and consumer discretionary is in the lower part. These three sectors are intimately related to each other. They're all technology sectors or consumer discretionary sectors that are really related to interest rates. It's unheard of for communications to be all the way up. And remember, this is the weakest sector of 2022. Technology to be in the middle and consumer discretionary to be fragmented like this. It's way off. This is a very fragmented market. Matter of fact, this is probably the most fragmented I've seen these sectors since I've started doing this. I mean, look at this. Communication services on top. Real estate is in the middle. Utilities is at the bottom. Energy's here. Consumer staples is here, but materials is here. I mean, it's completely out of whack. Completely out of whack. And usually, typically, when markets get this out of whack, they come back into normal wear and tear, if you will, or normal movement after a big pullback. Now, that's also something else. Look at the momentum levels. Communication services, 84 versus 56. 89 on information technology. 88. That's overbought. Look, I mean, let me just show you graphically how bad it looks. So to me, it looks like we need to cool off. I mean, look at that. Look at that. That's the highest 1, 2, 3, 4 times we've been there in 7 years, okay? And I know I've been saying that for a while, but folks, it takes a while for momentum levels to get up there. Look at information technology. All the way on top. All the way up. Very significant. All the way. Just like it. Let's see. 1, 2, 3, 4, 5, 6 times we've been up here. How about communication services? Let's look at communication services. And I know this analysis is getting old, but it's happening, folks. 1, 2, 3, 4, 5, 6 times. It's just not sustainable. And again, look at how all over the place everything is. Technology should be next to communication services. Energy should be close to utilities. Healthcare should be close to basic materials. It's a defensive sector. So everything is out of whack. And when you see 540-something stocks making 20-day highs and you see sectors that way and you see fragmentation, that's usually a time for the market to cool off. Another major factor is this. I want to show you the QQQ so you can see exactly what I'm talking about. Look at the QQQ and look at where it is, and it already filled that gap, and it's coming down, and it's going to hit the 200-day moving average. This is algos, folks. I was talking about it on Friday, and I'm talking about it again. This is algos. Matter of fact, look at some of the biggest companies. Look at Apple. I want to show you where it is, where it's bouncing off. Look at this. 200-day moving average. We go up, and now we're down already $1.50. We're already down. I'm telling you, as I'm sitting here right now, same thing right here. Algos take us out, and then they come back in. It's very, very, very frustrating, but we have to get used to it because this is the new way that markets are being traded. And you could see it with volatility too. Let me show you. I was showing you guys this on Friday. Look at this. Volatility makes a low, bounces off here, and then breaks down right here, and watch it take us higher again. It keeps happening over and over and over again. So it's not that we're wrong. It's just taking a little longer, and it's getting a little squirrelier, but it's moving in the same direction. Another interesting factor is look at the bond market. Didn't hit the 110, almost hit the 110, hit 109.35, but nonetheless, it's been backing off. And when the bond market backs off and starts going down, that's interest rates going higher. Interest rates going higher is not great for the market. So the sentiment right now is not all that great, and we still have earnings. Speaking of earnings, let's talk a little bit about that. Now, last week was the big FANG week, but only 50% of the S&Ps is out on the table. We still have a lot more to go. You've got Cummings, you got IDXX, you got Rambus, you got Pinterest, Skyworks Solutions, Simon Property Group. That's just today, take two. I mean, that's just today. Tomorrow, you have Chipotle, the big burrito. You know, I've never eaten a Chipotle before. I probably should try it one time. I've heard it's pretty good. They're looking for pretty good numbers. They're not looking for anything bad. It will be interesting to see how it impacts. You got British Petroleum tomorrow. You got DuPont, a lot of Enphase. You've got Fortinet, Gardner, H&R Block, Haynes. I mean, a lot of stocks. Jacobs Engineering, that's a good one right there. Prudential, Royal Caribbean on Tuesday. Western Union, and here's all the expectations. On Wednesday, you got the big rat or the big mouse coming out. You got earnings on Disney. They're looking at about 25% year over year, which is kind of realistic and sad. But you also have Avalon Bay reporting. You've got CVS reporting. You've got Emerson reporting. Equifax, that'll be an interesting one. Fox reporting. Goodyear reporting. Mattel, MGM. So we're not out of the woodwork just yet. We're not out of danger zone just yet. New York Times, Orly, let's see here. Reynolds, that's a good one right there. I'm just looking at all the stocks that we look at often. Yum, XPO, Uber. Thursday, you got PayPal. That'll be very interesting for the communication services. As a matter of fact, let's see where PayPal is right now. I'm curious. I haven't looked at it in a while. Let's look and see where it is in relationship to the 200-day moving average, right at the 200-day moving average. You see that? Sitting right at the 200-day moving average, and it's got earnings. Convenience? Let's keep looking at this. When you see stock sitting at the 200-day moving average at earnings, that's not a great sign. You got AbbVie, you've got AstraZeneca medical stock. You've got Borg Warner, industrial stock, Cloudflare, Expedia. Oh, I can't wait to hear Expedia, how good their travel sales are going. Hilton, a lot of travel stocks. Good. Kellogg's, very interesting. So there's Philip Morris, Ralph Lauren. That'll be interesting. Tapestry, that's Coach brands. Under Armour. I know a lot of people love this company. VeriSign, I love this company. They have great security for the web. And on Friday, we wind things down with Newell Brands, Fortis, and a couple of other stocks, but nothing major. The bulk of earnings will take place between today and Thursday, which is that's usually how it happens. By the end of this week, we'll have a good idea of where 2/3 of the earnings are. As far as Fed data is concerned, you've got international trades in goods and services, you've got jobless claims, and you've got consumer sentiment. This week is not as big as last week, but we still have to be very, very careful and pay attention to global economy. Let's talk a little bit about what's on the table. We went red on Friday as a blowout job data sparked fears that the Federal Reserve would keep hiking interest rates. Remember, if more people are working, it gives the Fed a license to keep. It's telling the Fed, hey, the market can withstand more rates. If people are working, that means they can withstand higher rates. They can withstand higher inflation. Theoretically, of course. In Friday's session, all three major U.S. indices went down. Amazon was down. Google was down. I'm surprised Apple was up. If Apple wasn't up, oh boy, we'd have a bloodbath. Now, here's the crux of the report. 517,000 jobs. The reason this is happening is probably because of all those people who've been laid off in the last couple of months from all the tech companies are getting jobs again. So this shouldn't continue at this rate, but it's crazy. It's almost 3 times what was expected. And unemployment is at a 53-year low, which is fantastic when you consider that we may be in a recession. Earnings this week are heating up. You got Disney, you got New York Times, you got Uber, you got CVS, you got PayPal, AbbVie, Pepsi-Cola, and Kellogg's. I forgot about Pepsi. I didn't see it in my list there. In terms of economic data, it's a busy week, but nothing like last week. The biggest ones is going to be jobless claims, consumer expectation, consumer sentiment, and here's the international one right here, international trades in goods and services. That's a juicy one I'm waiting for tomorrow. Let's see here. We're waiting for Federal Chairman Powell to speak again. He's said enough, and bond interest rates are higher, which means bonds are going lower. Europe took it under the chin because of the U.S. job non-farm payroll report. Investors are scared in Europe because this report may have a negative impact on European markets. So that's what they're getting nervous about. China also concerns over the U.S. geopolitical tension weighted on sentiment after the U.S. shot down a suspected Chinese surveillance balloon. I don't know if you guys watched SNL this weekend, but it was a couple of funny skits about it. Off the coast of South Carolina, so that's never a good thing. The Nikkei closed higher after Bank of Japan deputy governor, proponent of the Bank of Japan super easy monetary policy, would take over head of central bank. And in terms of stocks this morning, Datadog is down 3%, PayPal is down 2%, Tesla is actually up 1%, and Catalent on talks of a takeover is up 17%. This is a crappy company. In terms of markets, I believe volatility is going to start moving higher. I believe the S&P 500 is going to start decelerating and start cooling off a bit over the next few days. So be very, very cautious and start looking for selling opportunities. I think we're going back to the 200-day moving average. I think the QQQ is definitely moving back to the 200-day moving average. And the Dow Jones, let's take a Dow, which is kind of like doing its own thing. Now, why did it just shake me out there? All right, let's look at the Dow. And the Dow looks like it's still going sideways, and it looks like it's going to hit the 200-day as well. This choppiness on the Dow has not given us any favors the last couple of months. It's been very, very choppy. But I think after we break down, it will come back down and offset. So I'm not overly bullish on the stock market for many, many, many reasons. Most importantly, the sentiment, the fact that sectors are completely out of whack, the fact that the number of stocks hit over 550 high on the 20-week highs last week, and the fact that earnings are not giving us any catalyst for hope to the upside, not as of yet right now. And bonds, as you could see here, are not going higher. They're going lower, which puts more pressure on tech and consumer stocks. And honestly, and I'll be very honest with you, I've never in my life seen such fragmentation amongst these sectors. Industrial basic materials look okay. Real estate is totally out of whack. Energy is totally out of whack. Consumer staples is out of whack. The 3 tech sectors are totally out of whack. Everything is just totally out of whack, which means we're going to go through a major sector rotation, and that usually means to the downside, because whenever we get so fragmented, markets need to come down, cool us off, and bring everything back in line. I hate to say I told you so, but it's happening, folks. It's happening, and you can't expect these markets to go straight up forever, okay? Now, I love a good bargain. Who doesn't like a good bargain? And what many traders don't know is hefty bargains do exist in this market. And that's why I'm so darn excited about what I discovered. It requires traders to completely disregard a stock's share price and focus on the options. Now, with this little pricing mismatch that I'm going to be sharing with you today, even a tiny little weeny 1% move in the stock could lead to gains as high as 31, 41, 46%. I've even heard some people made 60.8%. Wink, wink, on a trade last week. So if you're up for a good old bargain hunt, I'm in for a good old bargain hunt. Join me today, Monday, 1 p.m. Eastern Time. I'm pulling the curtain back. Learn more about this brand new way to trade. You guys are going to love it. Follow the link below, and I'll see you at 1 p.m. Eastern Time today. It's the, 6th of February, Monday, 1 p.m. Eastern Time. Don't miss out. It's going to be really, really fun. And I'll uncover some very good tips for you and tricks. I'll see you guys later. If you don't know where to find the link, YouTube Wealth Press channel. Bye, guys. Have a great, great day, and I'll see you soon. Comment below this video.